Hedgeless Horseman here. It's April the 16th, 2024. Uh, market seems to be up a bit. Crypto taking it on the chin. Metals, gold is already back at $2,400. And you wouldn't believe it if you looked at the gold miners or especially gold junior miners, but gold projects at these prices right now, they are worth quite a bit of money, and who knows how long this bull will be or if it will have corrections or whatever. But the Western investor has not even found gold. This is mostly East buying still, I think. And of course, how do we know that? Well, just look at the gold junior miners, which are typically listed in Canada. And who can really buy, Canada listed juniors? Well, Canadians, of course, Americans too, I would think, and other people in the, I guess, Western Hemisphere. I can buy, or Western Hemisphere, yeah. I can buy via my Swedish broker, but another Swedish online broker I know of does not allow you to buy Canadian listed companies, except for if you phone in the orders. You can buy OTC actually, but it's like, that's the thing. There's a specific group of people that are the traders in Canadian juniors, and they don't care about gold. They do not care about gold. And given the fact that we know, retail people do not buy something if it's cheap. Price versus value is not something that most people actively think about. They say they do it, of course, and everyone has heard the line buy low, sell high. Obviously, nobody actually does that. That's not how markets work when retail is involved. People buy stuff that's gone up a lot, and they sell stuff that's gone down a lot. And few people buy the stuff that's gone down a lot, and they end up making all the money. And that's why you're seeing billionaires over the last 12 months increasingly buying into junior miners. And again, Elliott Asset Management setting up its own fund, raising $1 billion to go buy projects. They're not only bullish on the asset prices right now. If we like metals now, most commodities have pretty favorable demand supply outlook going forward. So if you think copper is doing well now, we obviously see a lot of shorts about an increasing copper deficit, and maybe it's not even arrived yet. Who knows? But you can imagine what some of these projects could be worth in that case. And maybe in the good old days it was easier to let's say have rising prices. Well, we'll put up a new mine or whatever. It's getting increasingly hard to put up new mines, so I would think that the supply demand, especially the supply side, is probably more inelastic than it's been in maybe ever. 100 years ago you didn't need a lot to start up a new mine. Africa is obviously one of the, or typically one of the better places when it comes to actually timelines of getting a mine into production, but there you obviously have the jurisdictional risk and just the perception risk and all that. But let's face it, the smart money is buying juniors. Retail is not buying juniors because they have gone down a lot, and the billionaires, the Pierre Lassondes, McEwens, Frank Oostras, Rick Rules, Landins, they are buying because they have gone down a lot. And they end up making all the money, but they don't really show up in the trading volumes because they can't get into these juniors at these prices. If you have a very small amount of capital as a retail investor, you could jump on pretty much any opportunity. But for the big money, the smart money, they cannot go in and buy $5,000 worth of a stock at ridiculous prices. It doesn't mean anything to them. And if they would take a position, on par to, that would be meaningful for them, at least maybe $1 million. Some of these juniors would be up 100% at least, I think. If somebody put in some would actually be up a lot more than that if someone just put in a market buy order for $1 million worth of stock. And of course, that's not the way they prefer to do it. They would like to get in at the lowest prices possible, so they can. When the companies announce the private placements, they will typically be set around the current share price, obviously, and there the big money, smart money can get in with size. And yes, sometimes, or often I would say right now, they get either half a warrant or a warrant. And I know some people say, well, they can make money because they get warrants, etc. The thing is, yes, it's favorable in that perspective for sure, but they are not as nimble. If you're a small time investor, small amounts of capital, you can again jump on almost every single, let's say, volatility event, and that might be meaningful for you. But big money cannot do that, so they have to wait for placements. Whereas retail can buy any single company at the market price, and even if they get try to get a full position, again depending on how much money they have, they might just move the stock price 10%, and that's nothing. Not from these cheap levels. But that's how it is. And interestingly, Shanghai gold price is up at 2,436, and that seems to have been, leading the way for this gold rally. So, this is signaling that we're not in right now for a correction in gold, at least, and gold is in fact, already climbing back to $2,400. I don't know exactly the price in silver, but yeah, look, recently, last 2 days, markets have had a hard time, cryptos had a hard time, gold is pretty much the only thing that's close to or at all-time highs, I would say. Let's look at some tweets. I've been quite active today. First of all, and I know, especially if you're new, it's hard to separate, what is a trading sardine and what is not. But let's just think from I always have a value investing mindset, but I will dabble in trading sardines. I absolutely do dabble in trading sardines, but still, if we're stealing values, like, how do you get really bullish? How do you get conviction? It's when, as a value investor, you actually think something has real value. In this case, like potential for a major significant discovery, and or a more de-risked project that actually has a legit shot of becoming a mine. And of course, the less tier 1 mines we find, and if gold keeps on going up in demand, if we don't find any more tier 1 projects, the tier 2 projects of today has to become the tier 2 projects of tomorrow. That's just, again, supply and demand. So that's a good thing, in the sense that if, we're not finding that many, new Carlin discoveries, and even, Snowland, which is, once in a blue moon kind of situation. Yeah, it's once in a blue moon, and it's in the Snowland's case, it's very remote. It's obviously going to be quite some time before that gets into production. That's a good thing. So it's like, I don't think ever more than now that, let's say, legit projects are peak valuable. What I mean by that is like, okay, in the Western world, in the tier 1 jurisdictions, are there deposits there? Yes, there are. A lot of places have obviously been, explored quite a bit, and it might be hard to find new tier 1 deposits there. But let's say you think there are some tier 3 or tier 2 deposits, which again could go up in value in the future, assuming we don't find a lot of tier 1 deposits. But and typically you get a jurisdictional premium, or if things really get bad and people are actually scared, Thomas Kaplan, he believes there's going to be a bubble within a bubble in the tier 1 jurisdictions. The problem with the tier 1 jurisdictions typically is permitting. Even if you have a good project, I mean, compare that to Africa, where it's like, yes, jurisdiction is worse, but there are some mining companies that basically only operate in Africa. And there you might go from a discovery to having a mine in 6 years, whereas in the Western world it might be 20 years or something like that. So there are trade-offs. But let's say projects that are good projects in tier 1 jurisdictions and actually has a shot of getting permitted, etc., etc. I think those are super rare today. And we know a lot of the major mining companies, they want to be in the tier 1 jurisdictions. They like Nevada, they like Canada, they like Scandinavia, stuff like that. And right now, the market driven by the retail shareholder is not a good pricing machine, if that's a way to call it. Because I made this observation before that, not long ago, I looked at 6, I think, silver junior developers. They traded, every single one of them traded between like 34 to 37 million Canadian. So obviously that doesn't make much sense. That, okay, according to, if we believe that the market would be a efficient pricing mechanism, so all of those 6 juniors had almost the exact same value proposition. I find it extremely hard to believe, and my point is that when retail is behind the steering wheel setting prices, things get wacky. There will be trading sardines that I don't think have a shot, or probably not a shot, of becoming actual mines. Either the project is not good enough, the deposit is not good enough, or it's in a place that's like, no, this is never going to work, whatever. And at the same time, there are more legit projects, which the retail shareholder is not aware is a much better project, but it gets traded like it's the same thing. So this tweet is basically me trying to say that there are a lot of stuff that might be down 80-90%, but if we're strict value investors, some of these projects might realistically never become mines, and in that case, how is an ounce in the ground worth anything in terms of value? The ounces in the ground are worth anything, or it comes down to how much a company makes from selling it, and then of course paying off all the costs of taking the ounces up from the ground. If you have no shot, you have no business, you have no way of actually monetizing the ounces in the ground. So de facto the value would be zero almost regardless, or pretty much regardless, at face value, whatever the gold and silver price is trading at. But if we find something that is actually has a shot of becoming a mine, and it's in a, let's say, a tier 1 jurisdiction and all that, they might be absurdly cheap right now. So you might have, let's say you have a trading sardine that's down 80%, but probably never going to become a mine. That's a trading sardine. It looks cheap because it's down 80% in price, and it's probably going to go up several hundreds of percent in the future, assuming it's still around. But it might never have been cheap, actually. It's just variations of expensive. Because if you have a car that does not work, Doesn't matter if it started off, selling for $30,000 and price went down to $5,000. It might look cheap, but if the car doesn't work, I mean, it shouldn't be valued as a car. It should be valued as scrap. Yeah, that's my point, because I see a lot of people, again, especially new people in this sector, they just assume that almost every company is created equal. And I think that's a bad mistake, especially if you don't know. I mean, if you know you own a trading sardine, that's a totally different matter altogether. Then you know there's certainly a time to sell it, and there might even be a time to buy it, which would be, I guess, around now. But just, let's say, thinking that I'm just going to sit on my hands and I'm going to ride this trading sardines, if you include dilution, I mean, they make absurd tops, absurd bottoms, or they crash a lot, they rally a lot, but it's like they are still in a downtrend typically, because they still dilute and the management still gets paid, even though it's never, the project is never getting monetized. Easiest way is, of course, I mean, the funny thing is, when I think about it, everybody has heard, I think, Rick Rule talk. Everybody's watched presentations or interviews with, Rick Rule, Ross Beatty, Landins, let's say. It's like Rick Rule points out that 80% of the gains can come from 20%, or 80% of the value creation comes from 20% of the people's, the Pareto's rule or Pareto's law. And his advice to himself would, if I only bet on serially successful people, I would have done better than trying to be too cute, or, buying, let's say, unproven management teams and all that. So, I mean, it's kind of interesting that what are the things that, the billionaires are saying and doing right now. We know Pierre Lassonde says the gold mining sector is the easiest sector in the world because it always crashes and always rallies. Well, it has crashed. And in his words, it will rally. But nobody's buying that. Okay, no retail is really interested in that. Okay, why do most people end up losing money? Of course, because they do the wrong things, right? And then you look at the Landins, for example, their companies tend to, I mean, their hit rate is just abnormally good. And that's also, a group, let's say, that, Rick Rule would say, just buy Landin companies and you're gonna do really well. But almost nobody actually does what the billionaires say. Nobody buys low or sells high. Nobody buys cheap and just sit and wait. It's like Rick Rule when he often say, I mean, his uranium bet a few years back. He said that, well, sooner or later the prices of uranium is going to go up. The price of uranium is going to go up. It went up. Might have taken him 2 years to get a multi-bagger, but absurdly good returns. If you can average a multi-bagger, let's say 2 to 400% every 2 to 3 years, that's absurd payoff. The compounding effect from that is absurd. But of course, most retail investors, that's too low for them. Most people follow every single daily swing and they pretend that they are long term. They say they're after 10 baggers. But getting back to the point, I mean, I would argue that almost nobody actually listens and does what the smart and big money actually say you should do. Buy cheap, hold until it's not cheap. That's it. I mean, and of course, I mean, start off with picking, above average quality companies. So, I mean, this tweet, to sum up how the billionaires make money, of course, this is an oversimplification, but it's like, buy good looking projects when they are cheap, bear market. I mean, that's what the Landins are famous for. Picking up Fruta del Norte, or in their exploration efforts. I mean, it took a while, but NGX, Philo, they're all doing well. not that every single Lundin-backed company is gonna do well, but it's like these guys can't really trade. I think they've said it as much that they buy once and sell. They buy once and sell once. How is that for activity? Buy once, then maybe 5 years later, they have a project that gets acquired or they could sell. But they can't really trade easily. They can't make 200% over 2 years and just, oh, I'm getting out, I'm dumping my, their position. They might own 10% of the companies and stuff like that. So they have a very hard time. It's like they need to believe it's a really, really good buy for them to get involved, because they can't change their minds. So they literally do nothing but hold for, few to several years. And then they, if they can, sell when it's not cheap, like they sold the Redback mining in 2011, I think, for $9.2 billion. They weren't in love with that, but it's like, hey, $9.2 billion for or 2 mines in Africa, that's a good deal, we're out. And they made a crap ton of money doing it. And yeah, this is just, again, an homage, I was going to say, to how most people are. And you can see it on Twitter every single day. Everyone's after 10 baggers. I mean, a lot of the time, let's say, you want to get interest to your junior, you want someone to buy them up. You're going to, say, this is a 10 bagger. I mean, it's not like I don't ever say it myself. But it's like, pounding the table 10 bagger. But that realistically takes, a few to several years, even if they actually do end up becoming 10 baggers. But the same people, they comment on and get affected by every daily move. If gold is up and gold juniors are down, they bitch about it. If gold and juniors are up, they celebrate like the 10 bagger has already happened. When gold and silver is down, they, get depressed, like they're never gonna get ever gonna have any returns. It's just crazy when you think about it. The funny thing with that, and it's like I discussed with a friend of mine recently, when your holdings are up, let's say we have a good old day in gold. Let's say gold is up 2%. Or let's say gold is up 4%, your juniors are up 10%, and everybody is cheering like crazy. They're not actually cheering about the 10% move in the portfolio. They're in it, at least at face value. Everyone is in it to get rich and rich quickly. So why would you cheer a 10% move in juniors? It's obviously not the 10% move people are cheering. It's what they assume is going to happen if this just keeps on going. I hope you understand what I'm getting at. And that's also a reflection of how short-term and momentum-driven we are. When something goes up 10%, we get super excited, not because in reality of the 10%, most of it is not because they're up 10%. It's that we're starting to think that, whoa, at this rate, they could be up, 300%. We're starting to already price in future returns as soon as we see one day of a directional move, in this case to the upside. Otherwise, let's face it, if you are in fact, as you, let's say, claim to be after 10 baggers, and even every single junior you own is up 10%, how much does that matter if your goal is 1,000%? Not 10, but 1,000. You're cheering like you're sitting on 1,000% return already. But that's again, it's like why I say now and then that start to train yourself to not care. I mean, it's a good way to kind of gauge your own conviction, let's say. How emotional do you get from a 10% rip in some juniors? I typically do not comment a lot if some of my juniors might be up 10 to 20%. Why? Part of that is because, okay, I'm not in it for 10 to 20%. I'm in it for, let's say 200%, 300%, 400%, 500% over 3 years. We're not even close to that. So why am I sharing? And also to train myself that stop sharing or get depressed by every swing. If you share every single daily uptick in your portfolio, by default you have to mourn and get depressed of every downtick. And again, that goes back to pricing in the future. If it goes down, you get depressed because you think it's going to continue down. If it goes up 10%, you get ecstatic because now you think, oh, now 1,000% return is just around the corner. Whereas if we're honest and it's like, okay, we've looked at charts, we know that hundreds of percent of returns doesn't happen in a week. I mean, this sector is one of the most violent revaluators in the financial markets, but it's still, even in an extreme bull leg, it can take 8 months to get 2 to 500% from the literal bottom tick. We should be happy if it takes 200% to 8 months from here to get 200% on our average holding. That's still 8 months. 8 months. 10% in a day. If you did that for 30 days in a row, I mean, I haven't done the math, but it's just absurd returns. We cannot expect to have such returns. But you still see it's like, oh, let's say juniors are up 20% in a week. Monday they start off minus 5%, and people start bitching. Like it's not whatever. Let's say 15% in 6 trading days is not superb already. Just another example of nobody really has any clue how returns are made, how long it takes, or how the stock market works, or the effects of compounding. I've seen people bitch as soon as a stock is off its all-time high. I've seen people declare bear markets in gold as soon as it's down 1% from the all-time highs. No, most people don't have a clue what they're doing. They don't know what even good long-term returns look like. They have an idea how they think they look, but that's because they really don't understand it, and also why most never actually have it, because it goes without saying. I was gonna say that if you don't have good long-term returns, if you don't have a good investing strategy, you have no idea how good returns are actually made, long-term good returns. You just keep, let's say, chasing the idea of how you think good long-term returns are, which is typically that, whatever I buy should just go up and go up and go up and go up. It should be up every day, every week, every month. That's how you get good long-term returns. But if you actually look at some charts of 10 baggers, 20 baggers, very, very, very seldom does it take less than a year. And even if you looked at, last video I think I showed how the Bear Creek Mining, how Bear Creek Mining rallied in the 2016 rally, which was absolutely epic, by the way. But that's still, most of the time throughout that 8-month period, it consolidated. And silver had pullbacks within those 8 months. Bear Creek had pullbacks and consolidated, went sideways. So if you look at the chart, I bet people would 100% sure that 95% of people would bitch all the way up to, let's say, a 600% return. Because they're so caught up in the now. Oh, silver is up. My junior should be up. It should be up every day. Otherwise, it's a testament that people don't really know why they're holding something, or again how the markets work. Everybody expects that, oh, how I make my money is that I'm going to buy a stock and then it's just going to go straight up. Not a single day of downtick. If I see a single day of downtick, or God forbid a week or a month, I'm going to start bitching. Every single day it's not going up, I'm going to start bitching. Even though, again, despite the fact that no rally, even the most absurdly profitable ones, went straight up. And a lot of the time the juniors are simply consolidating. They go up. Let's say they go up for a week. Then they might consolidate for 2 weeks. Then they go up again. And silver might go up, and then it might go down 5% or whatever, within an immense bull leg. That's how markets work. Nothing goes straight up. But you see, again, everybody is so focused all the time on every single daily move, whereas I'm sitting back, it's like, okay, some of these juniors I own, I think they're undervalued by, I don't know, let's say easily 200-300%, just based on how the projects look right now. Include growth over the next 3 years, maybe I think they can be undervalued by 600-700%. Why on earth should I be sitting here worrying about every daily tick? If it's down 5%, who cares? If it's priced at 50 million, I think it's worth 200 million. It goes from 50 million to 48 million. Who cares? Who cares? If it goes from 50 million to 52 million, who cares? We're not even close to what I would in that case consider like, yes, this is absolutely a time to think about taking profits. I mean, what we're seeing now, the swings in these juniors, I mean, it's like they're rounding errors. I mean, I've seen juniors go up 100% and they're still cheap. But of course, everybody hates, again, paper losses. To be called a bag holder, that's like the nightmare for people. Mostly because, people don't really know how to invest. And people get upset if they get judged by other people who don't know how to invest. You see people call other people bag holders and stuff. That usually comes from people who don't know shit themselves. But misery loves company, and it's typically a reflection of how they feel about themselves. So if you get hate, if you get trolled, it's typically from people who are doing worse than you. I don't see successful investors or billionaires trolling other people on Twitter or anything like that, or in the forums. And keep in mind that nobody has as good returns as it looks on Twitter. Not only that, I see people throw that, stuff at me all the time. It's like, I bought this junior and sold it at whatever price. I mean, bragging about short-term trade, short-term profits. That's one trade, which I can't even verify. How impossible or how hard is it to at least get one good short-term trade now and then? I wouldn't say it's impossible. If I own 20 juniors or buy 20 juniors, now and then you obviously are going to have a possibility of saying, well, I'm up at this. I'm up in this stock. Look, it's gone up 30% over the last 1 week. And of course that's kind of to, ego stroking and hoping that people will say, oh, he's, to admire you. Oh, he's such a good investor. Oh, he's such a good investor. But do you have any idea what their long-term returns are? No. Do you know how much money they're playing with? No. I mean, I see some people brag about, apparent trades in, 3 million market cap companies, where the average traded volume is peanuts. So how much in terms of long-term investing success do you think a person like that has? If he's busy short-term swing trading a 3 million market cap company where the volumes are like peanuts. Not much. But a lot of people are happy to brag once they get a trade like that to be a success. My point is the important. If you want to look smart and look good and can't cope with looking bad or people calling you a bag holder, whatever, you should probably not be investing, or at least actively participating in forums and Twitter, etc. I don't have, especially for exploration success, I don't have close to, I think, 50% hit rate. And of course, I get trolled immensely, typically, when something goes south, if an exploration stock doesn't work out. If I can't handle that, I have no chance in this sector. Because in the, let's say, the peanut gallery perspective, if you buy anything and are openly bullish that and it has paper losses, even if for a period of time, they're gonna ridicule you. So how do you avoid that? Well, either not taking any public stance or whatever, or just keeping it to yourself, which I think is probably a very good idea for most people. Or you simply have to stop caring and focus on the fact that, well, the important thing is how my portfolio does over the long term, not only how my portfolio looks to be doing in a bear market. I hope that makes sense. Because I know a lot of people that seem to be extremely sensitive about ever looking bad. A lot of people especially in this sector last a year especially, a lot of people that during the highs you're gonna see people throw out pics and brag about their wins and all that. A lot of people don't even dare to comment that they're bullish on any juniors. And I've seen some people that are, have been kind of ridiculing junior gold, silver investors, junior mining gold and silver investors over the last, let's say, 2 years. And now when they've gone up, they're getting a bit of FOMO, like, oh, I should be getting into this. And at the same time, in some of these juniors, anybody that bought at any price over the last year are already in the green. After this run-up. But until the run-up, you would have looked like a complete bag holder for maybe 1 to 2 years. But at the end of the day, the guy that's been ridiculing you perhaps, let's say he's getting in now and you're already in the green in some of these stocks. And let's say, the juniors would go straight up from here. He's going to make money. You're probably going to make a lot more money. But the price was that you looked stupid for 80% of the time, where he's, looked smart for 80% of the time and looked pretty smart for 20% of the time, but you still end up making more money. So again, what is the goal? Are you after looking smart or actually making money? If you want to look smart, I guess the best thing is to say goodbye to the really big returns which comes off from bear market bottom. And like people have pointed out, I think Rick Rule said it as much, you have to be prepared that assuming you don't buy the exact bottom tick, which is pretty much impossible, you're going to be down on every single buy before you're up. That goes without saying. You're going to be down on every single buy before you look right. Let's see here. Well, Newmont might, or I was going to say Newmont might be a bad example, but anyway. Well, let's take the SILJ actually. Juniors have done even worse. Oh, nice. Might be a hammer coming there. Look at these swings. Again, if let's say you started buying here, it ran to this level. So any purchase below here ended up being in the green within 3 years. Every single purchase. Every single purchase bought in this rectangle here ended up in the green at the peak. Let's say you started buying here. Oh, it's gone down a lot, so it's like, oh, it looks, let's say it not only looks cheap, but is cheap. Well, this market doesn't turn around. This sector doesn't turn around when it is cheap. It turns around when it's irrationally cheap, extremely cheap, and tops when it's irrationally expensive. So let's say you start buying here, 2014. Buy all the way down, buy all the way down, buy all the way down. In the meantime, somebody is ridiculing you, whatever, ridiculing you for buying in here. And down here, they're absolutely ridiculing you, calling you a bag holder. Wow, congrats, you know, shaved off 60% of your portfolio. What a stupid person you are to be investing in this sector. This sector sucks. This sector absolutely sucks. But you were averaging down. And let's say you had a value approach. So you actually ramped up the buying. You started buying here when you thought it was cheap. And in your eyes, it only gets cheaper and cheaper. So you buy more the cheaper it gets, all the way down to the peak. More buying, not less buying. The lower it goes, the quicker you're decreasing your average price. So at the bottom here, let's say you, again, because you ramped up your dip buying, you got your average all the way down to here. When you're here, you're in the red on every single buy since you started out. Every single buy, 100% of your buys, you're looking stupid. Bag holder, every single time you put out a buy rec, let's say, you know, in the forums, buy rec, all the way down, all the way down. Stupid, stupid, stupid. Let's say you did it 100 times in a row over this period, and you actually did buy 100 times. 100% of your, quote, buy recs would show a loss at this bottom tick. But your average is down here. Let's say you're still down 30, 40%, whatever. This sector would only need, and of course you could probably buy in with size, given that you accumulated over such a period of time. You didn't jump in, and especially this goes for juniors where the liquidity is low. Let's say your average is down here, and you're red on everything. You're red. Your portfolio is down, even with the dip buying, and even if you bought the down tick. Let's say you're down 37%. Feels horrible. People calling you names, portfolio is red, all of that. Well, when it turned around, you're back to break even within a month. And then you, everything above that was gravy up to 200%. So you looked like a complete moron, idiotic, 100 times in a row, 100 buys in a row. From the bottom, when you were down 37%, you would end up 204% in, let's say, 2 years. That is a really, really good return. Really, really good. You can get even better returns if you buy even more the lower it goes, or you start buying here instead of here, yada yada. But the best way, of course, I mean, that's the offense and defense, or the curse and the cure. This is where you have max pain. This is when it's easiest to actually rectify the situation simply from buying more. You're lowering your average all the time. But again, let's say, you did that and somebody was ridiculing you, and he's like, oh, he's seen this move here. It's like, oh, I'm never getting into minors, never getting into minors. But it's like when he sees that this wasn't the top, and this wasn't the top, it just kept on going, then it's like, even he might be convinced that's like, oh, wow, I see people making money now. I see some juniors are up, 200% in 2-3 months. Jesus, I mean, now I'm looking stupid here because people are making money left and right. Then they don't want to look stupid, so they buy in. So maybe that guy buys in here or maybe here with whatever he can get in. And yes, he might, if he top ticks, let's say he actually gets in here after it's broken through this resistance or whatever, and the sentiment is obviously increasingly bullish. People are talking about $50 silver and all of that. So he buys in here. If he top ticks, he'll get 35%. Your margin of safety, you will have a 35% gain here already. If he literally top ticked his sell, which is almost impossible, he would get a 35% return. You, with probably a much bigger position, and hopefully you done due diligence, you're in high quality juniors, and in that case these returns won't even come close. So again, even if he, let's give him a top tick. Let's say he bought here, sold here. Let's say 38% on whatever amount of money he invested. So he looked smart when you look stupid for being negative. And then when you're starting to look not so smart and you're already in deep profit, he buys in, and let's say sure he gets this bottom to top tick on whatever amount. But you, let's say in an ideal world, you sell when he sells. So he will never really have looked that wrong, especially if we're talking amount of period, because the only time he really looked wrong was from here to when he got in. And this is the amount of time you looked stupid, 100% stupid, increasingly so. And here you both, let's say, look smart. So you only looked smart. Well, I guess you looked smart from this as well. But it's like, okay, this is the amount of time you look smart. This is the amount of time you looked super dumb. And down here you looked again like the worst investor on this planet. And this guy, he never looked stupid, let's say, but he only looked smart for again, depending where he got in, this amount of time. So he has 100% in a sense hit rate. He was out during the big cascade. He bought in with, let's say a minuscule amount, or maybe a lot, I don't know. But this is so he has at face value 100% hit rate. You have, okay, this is, I was going to say, let's say you get in here, whatever. You look wrong, you look stupid for 80% of the time, look smart for 20% of the time. You're still going to end up making a lot more money than this guy. If he top ticks, he gets 38%. When he gets a max return of 38%, you theoretically have made 200%. And I mean, in reality, this guy might be averaging up, because now he again looks smart, and that makes people want to do it even more. That's what you see in crypto. I mean, it's a one-trick pony. If you made your money in crypto, you're probably going to think that I'm going to make all my money in crypto, so you're going to hoping that the gravy train continues forever. So in reality, he would not top tick here probably. He would probably increase his buying. But you who just lowered your average, I mean, this is, if you didn't do a single other trade than buying all the way down, anything above this level here is you free rolling. Here you wouldn't have a lot of profits, but at least you would be in the green. The guy who didn't look dumb and bought in here, he would already be down a lot if he didn't sell the top. That's my point. That is pretty much my point. If you're a value investor and you catch falling knives, because that's when the returns are the highest, you're gonna have to be okay with being called dumb, looking dumb for an extended period of time. At the end of the day, you might make more money than the person who looks right 80% of the time, even if you look wrong 80% of the time, and only right 20% of the time. Let's see here. Yeah, I mean, okay, I'm not gonna go in too much depth, but it's like, how do I cut through all the bullshit, let's say? I mean, you know, Twitter's like, I don't know how many tweets I see in a day. Let's say 1,000 tweets. And it's gonna be about anything from Fed to, I was gonna say, where the wind is blowing. People are gonna throw shorts at you, COT reports at you, inflation numbers at you, geopolitical events at you, guessing where their impression of where the gold price is gonna go soon, yada yada. So you're gonna get bombarded by 1,000 different factors from 1,000 different people every single day. Almost nobody actually makes any money. By that I mean outperform an index. So it's like, even if you're an expert on macro, does that necessarily mean you're necessarily gonna be a profitable investor? No, and only you are stuck to your portfolio. Are there people out there that I think appears to be good at technical analysis? Yes. Can I use their work really to trade by? No. Because I'm not them. I don't know their exact buy conditions or their exact sell conditions. If you buy because some short guy, unless he like, okay, this is exactly what I'm gonna do. And again, if you believe he's more right than wrong, or at least that he doesn't even need to be more right than wrong, but yes, if the bets are asymmetrical enough, and he might only need to be right 30% of the time. But my point is, if you follow someone in just because someone buys because of his strategy or whatever, the only way for that to make sense if you also exactly copy the sell conditions. Otherwise, you might be lost out there. Let's say somebody gets you to buy, and something goes up 100%, and the one who put out the short, he was like, yes, this trade only makes sense if I take profits if it's up 100%, because it's a trading sardine or whatever. But you don't understand that. You think, oh, it's up 100%. I mean, now I'm getting increasingly bullish on this because it's up, because that's how we work. So you might not sell any, or even add more, because that has worked so far. And then it's like, that guy would have gone out, but you don't know why you got in really. You didn't know the strategy that was deployed. So you hold on or actually average up, and then a correction comes and you end up selling, whereas that other guy might have sold where you added, and then bought back when you sold. So you have to come out, the buy and sell conditions have to match, whatever. I again have a very simple theme. I'm trying to, I hope, it's so brain dead in a sense that it's like a strategy almost sounds too much of a fancy word. I buy something when I think it's cheap. That's like the main strategy. Yes, I have some, let's say, put on a trading sardine or whatever, but usually I don't, stay too long in those because I don't have conviction. I buy when it's cheap. I sell when it's not cheap, or I find something that is cheaper. I don't make any buy or sell conditions on anything here. As soon as I start doing that, I'm not sticking to my strategy. As soon as someone else gets me to sell, it's not, again, necessarily their intention, but it's like they throw out something. I get scared because they say rates are going to go wherever. Real rates are going to go higher, and that, quote, means it's bad for gold, whatever. That makes me sell, even though it's not, even though it's still cheap. Then I'm not following my strategy. It should be a closed circle. Your buy and sell decisions should be they should be coherent. Not that I buy if it's cheap and then I sell if the COT report, according to some guy, says it's bearish gold, and then I end up selling because I get scared. What was the strategy in that case? Buy cheap, hold until some guy gets me to get scared. Does that sound like a good long-term strategy? I don't think so. But this is what sells. Almost every panel or guy that gets interviewed who is an expert in the space, they all get asked about all of these stuff. What the Fed is going to do, how the rate cuts are looking. It's like there's millions of analysts looking at the rate, following Fed's every movement. Do I have an edge over that? I don't think so. How do I make up a coherent strategy that can be deployed long time from guessing what the Fed is going to do, and not only that, but guessing what other people are guessing, and how they're going to react to my guessing? And again, it's like sprinkling some truths. We remember everyone said that rate hikes were bad for gold. Well, I remember 2015, Fed hiked rates for the first time. That was the bottom in the gold price. That's just before the epic rally. So everybody said a hike in rates would be bad. They hiked rates, and around that time the best quarterly rally in miners almost ever started. Real rates, if real rates are up and USD is getting stronger, that's bad for gold. Well, that has happened recently. Gold is at 2,413. It's gone like this, and I don't think the dollar's crashed. Oh no, okay. See. Oh, and even gold, which the gold miners obviously one would think should follow. Gold has been going up. Miners are not near all-time highs. Miners are near multi-year lows. So what kind of conclusion can we draw? Even if you're invested in miners, focus on miners. If you're a stock picker, focus on the companies. Because even if someone was correct in 2015 saying Fed is going to hike, okay, Fed is going to hike, everybody says it's going to be bad for gold, you would have sold the bottom. Okay, that's not good at all. If somebody had a time machine and just let you know, hey, real rates are going to go up over 6 months. The USD is going to hang in there or go up over 6 months. And you heard that, well, that's bad for gold, so I sell gold. Well, you missed out on a pretty epic rally. Broke through all-time highs. Broke through a fat consolidation. If somebody said that, well, gold is actually going to be up, they don't tell you about the rates or anything. Gold is going to go up. Well, my gold juniors, let's pick a better period. From here to here, whatever, or here to here. It's like, oh, gold is going to go up, so it's like pile into gold juniors, and you would be expecting a leverage return on that, obviously. But gold miners didn't do that much. Let's see here. No, I mean, nothing goes straight up or straight down, but it's like, and actually, I mean, if you have timed every single bottom and rode it to the exact top, yes, you would have made money in GDXJ. But still, this is GDXJ. If somebody told you back, whatever, here, when gold was at, I don't know what it was at, $1,800 gold, it's like, gold is gonna hit 2,400 in 2024. Or maybe whatever here, let's say. Yeah, gold is gonna go on a 4-year bull run. All things considered, yes, consolidation. You would expect to be up a lot in gold miners. And you were up for a while, but even now with gold at all-time highs, miners are still down here. Again, my point is that there's 1,000 different unknowns, and there's a 1,000 different things to look at. There's a million people out there throwing their opinions on 1,000 different things. And if you if you let any of that influence you, especially if you're a stock picker, I think you're gonna go wrong. Because even if somebody's right on a macro indicator, or where something is going, where the real rates are going, even where gold is going, it doesn't mean that if you're investing in, if somebody says knows for sure gold is going to go up 2,400%, and this guy was from the future, obviously you would buy gold because gold was going to go up. But you would probably think that, oh, miners should go up a lot as well, but they didn't. Gold and gold miners are not the same thing, even though they are intricately connected, obviously, but not when you factor in, in the short to medium term, if you factor in how people act, it's not a given anymore. Because we see that right now, Western investors have no clue what they're doing. They have no clue how cheap these gold juniors are. Higher quality ones, especially. Something I would like to touch on, actually, is like correlation economics. I think he does a good job. He does a lot of, try to do math stuff. Okay, how at this gold price, how much? I don't think what his metrics are here, if it's EVs to free cash flow or whatever. But okay, 10% discount rate, and we can see here it's like, okay, we're at $2,400 gold. There's several gold miners that, if you drew a line here, they are undervalued by, let's say, what do we have here? Like even maybe here, yeah. So even here, it's like several gold miners undervalued by 100% at face value. Then up to 200%. Some appears to be undervalued by 300%, up to 400%. That's gold miners at the current gold price right now. So according to these metrics, they are cheap. A lot of them are cheap right now. They should be, at face value, they have multi-bagger potential right now at the current gold price. This is for some silver miners. Where's silver at, actually? Silver is at 28.4%. Dollars, 28.4. Yeah, so around here. This is the zero. So there's a lot, just again, at a snapshot view, at face value, a lot of the silver producers are still overvalued. So if you want returns from a value investor's perspective, silver would at least need to be 30% for there to be any. A lot of them are still overvalued, actually. But that's my point. This market this sector is totally whack. That's why I still prefer gold beta, because they are actually cheap right now. In silver, if you at face value, if you own some of these producers, you're kind of, I mean, according to this chart at least, you're paying a speculative premium. What you're buying is not even cheap, even if it's down, let's say, 70% from the multi-year highs. You're overpaying for something, and what you overpaid for will only look cheap if gold goes to $34, let's say. That is not a great bet for a value investor, because you're paying a speculative premium. You're paying for a rosier future that has not happened yet. You don't have a margin of safety. It's like First Majestic, according to him, only has upside, fundamental upside. I mean, we know every mine runs out and all that, and stuff can happen, but it's like a snapshot view. First Majestic is only cheap at these prices if silver hits $40. That is not a bet I would like to take. From a trading sardine perspective, yeah, we know First Majestic can go nuts. And I pointed out during the recent bottom, it looks like it when it bottomed in 2015-16. And First Majestic went on a tear. And I sold that long before it reached the top, because I already thought it was getting overvalued. Just because something is overvalued doesn't mean it can't go up. Just because something is cheap doesn't mean it can't go down in price first. But I think, I mean, again, if you're a speculator and you know they're trading sardines, that might not matter much. But I'm just saying, from a value investor perspective, that's what I'm trying to stick to. Buy, did I close that down? Anyway, buy cheap, sell not cheap. I am not rushing into silver miners per se, because most of them are not even cheap, even though silver is up to 28. Will they be cheap if silver? Will they be cheap today if silver goes on a tear and goes up to, I don't know, 35, 40, 50 bucks within 6 months? Absolutely. But again, that has not happened yet. That's a bet. That's a speculative bet. That's a gamble. If you're buying some gold miners that are already cheap right now, you're getting a speculative discount, because the market is giving you kind of odds, let's say, that, hey, even if giving you a price that even if gold went down $200, you still bought it cheap. So you have a margin of safety. I mean, some of these gold juniors, I think they are, especially the real legit ones, they're probably even cheaper than some of these cheaper producers, although more risky, of course. I think I have a huge margin of safety in gold beta. I don't think there's a lot of margin of safety in silver beta. Despite that, I own silver beta, because I know what can happen in silver, yada yada. And it's a bit fun, but my core positions is not in silver beta. Well, actually, that comes with a twist. My largest holding is a private silver company, but that's a legit business. That's not a high cost producer or anything like that. So I'm betting on the company in that case. That's why I stick. At the end of the day, I stick to picking companies I think are cheap. A company might be down 80% and not be cheap, like we kind of see in some of these silver producers. A company can be down 80% and be extremely cheap. I think I'm gonna wrap up there, actually, because it's already gone on for too long. Thanks for listening. If I mention any companies, assume I'm biased. Some might be banner sponsors, not investing advice. But I think this is, again, maybe help some people to like, oh right, the best thing I can do is probably shut off Twitter. And, consider the fact that, okay, when does the value of the companies I pick, when does the value change for them? Do they change with price changing, share price? No, that's not value. Does it change materially if gold is up 1% or down percent? No, not really. I mean, they probably won't be in production for, even if they have something, maybe in 5 years. So if gold is 2,400 a day, it doesn't really matter in the sense that you're not producing anything. You're not getting paid $2,400 per ounce. When they start producing, gold might be at $5,000 per ounce, or $2,000 or $1,000 per ounce. That's when the rubber hits the road. Company value changes on news releases. Price of companies changes every single day based on 1,000 different, 1,000 different noise events and how people react to them. And not investing advice. Thanks for listening. Bye.